If you're buying or running a business, this is a golden nugget of information that most people do not understand. It relates to operating in financial leverage. Even John said, I knew the rules, but I didn't understand how it works. So please take the time to watch this 15-minute video. Very critical.
All right, the topic this morning, operating in financial leverage. Let me give you a kind of, I like to do kind of simple diagrams. Let me introduce this topic and then we'll give you some formal rules and show you some things. But essentially, if you've got revenues here, and operating costs, and this includes cash costs like wages and salaries, utilities, and also non-cash costs like depreciation and amortization. Amortization is the same for intangibles as depreciation is for a physical asset. If I amortize goodwill. If I buy a physician practice for $500,000 and it's only got $200,000 worth of assets, I put $200,000 of assets on the balance sheet plus $300,000 of goodwill. But I got to write that goodwill off in exactly the same way that you write off the value of a piece of equipment and pass some portion of it through the income statement every year as amortization, but it's exactly the same as depreciation. Minus operating costs equal operating earnings, EBIT. Now I've said before, this is what you guys as managers and leaders are responsible for. This is a reflection of how effectively you're using the assets of the organization. Then you go down here and you subtract out interest, and taxes. And what you get is net income. And that's the bottom line. Like I said, you as the manager are responsible for that. Then the finance folks are the ones that determine how your organization is financed as between debt and equity, or net assets in the case of healthcare it's called. And of course that'll determine, plus the rate of interest out in the market, will determine what your interest costs are. Now one thing that you might have observed, but never really thought much about, is that relatively minor fluctuations I'm going to see if I can. Oh, is this dry erase, low odor? You slipped one in on me, but I caught it. Relatively small fluctuations in revenues tend to be reflected in larger fluctuations in operating earnings. I'm gonna give you numbers in a little while to show you how this works, but right now just take my word for it. That's true. And these larger fluctuations in earnings before interest and taxes are reflected in even larger fluctuations in net income. Now clearly, you can kind of intuitively see if this is true, it works to your benefit when revenues are rising because net income will rise at an even faster rate. If revenues are rising like this, earnings before taxes are rising like that, net income's rising like that. But it also goes the other way. If the pressure on revenues is downward over time, that downward pressure is magnified in earnings before interest and taxes, and even more magnified in net income. So you might think off the top of your head that a 10% variation in revenues would lead to a 10% variation in operating earnings. It doesn't, 15%. And the 15% variation in operating earnings will lead to maybe a 20 or 25% variation in net income. Works for you when revenues are rising, works very much against you when revenues are declining. Now, what in the world causes that? First, I'm going to really define it and kind of just postulate what causes it. And then I'll try to show it to you with some examples. And then finally, we'll say, okay, if this is the case, what does this imply for how you run the business, how you manage your people? It has big implications for how you lead and manage your people. What determines how much these fluctuations in revenues are magnified in operating earnings? The factor that determines how big that magnification is the percentage of fixed costs here. Higher percentage of fixed to total cost, bigger magnification. Lower percentage of fixed cost, lower magnification. Now you ask about Optum. Who asked about Optum? By not having heavy operating costs, hospital depreciation, by not having that heavy fixed costs in its operating costs, the fluctuations in revenues are less magnified in the fluctuations in earnings. And by financing with equity, which I'll get to in a minute, you get more stability in net income. What is it that determines how much a fluctuation in operating earnings is magnified in net income? It is the percentage of fixed costs below the line. Interest is a fixed cost. You got to pay it or you go bankrupt. If you've got equity here, dividends are discretionary. You don't have to pay them. So, low fixed costs, that is depreciation, low interest means that fluctuations in revenues are not nearly so, don't lead to nearly so violent swings in net income. And the more stable your net income is, the higher your equity value is, because it's less risky. But if you have high fixed costs, like tenant or HCA, and you rely on a lot of borrowing to finance high fixed costs here below the line, you get a lot of variation in net income. And that makes the stock less valuable, because a stock is dependent value, at least in theory, on the level of earnings, net income, and the stability of those net incomes, the dependability of them over time. So it has a big effect on corporate strategy, which way you want to go.
Is that why Tenet sold 4 of their Florida hospitals last month?
That certainly figures into it. I'm going to posit here. I'll come back to this. But for you, if you're working a health system, a hospital, or asset-heavy system, and you're running into headwinds and the revenue is under downward pressure, and you have heavy fixed costs, you try to convert as many of those fixed costs into variable costs as you can by outsourcing and laying off your semi-variable personnel and going out for PRN, for the nurse temps. Even though they may cost more, you're substituting variable costs for fixed costs, and that lowers the downward pressure on your operating earnings. Now, I'll show that to you with some numbers. Just take my word for it for just a second. But this is where we're going to go with this. The magnification changes in revenues, and most organizations, most healthcare organizations, most asset-heavy organizations are in that kind of trajectory. And the reason is because of shifting sites of care. So, and it's because heavy fixed costs here in as a component of operating costs, and heavy borrowing, dependence on borrowed funds here. But let me put some kind of formal bounds around this and give you some numbers to kind of show you. I mean, I didn't understand this until I sat down with a sharp pencil and kind of, oh, all right. That's what we'll do here. Bob, can you turn that on for me, please, sir?
John, is this commonly understood in the industry? You said, it scares me when I hear you say that you didn't understand it till you stopped and thought
Well, I
about it.
didn't. I knew the rules, but I didn't understand why it worked. Leverage is the measure of the sensitivity of a firm's income. Either it can be operating earnings or net income to any given change in revenues. How sensitive is it? You are most interested in the sensitivity of operating earnings, because that's what you're responsible for. Your poor old CFO is at the bottom of the food chain here. He's responsible, or she's responsible, for the stability of net income. So she depends upon you to provide some stability in operating income, and then takes responsibility then going on down to net income. But we'll show that in a minute. But that's the definition of leverage. Leverage is a measure of sensitivity of one thing to another. The degree of leverage, how much leverage there is, depends upon the ratio of fixed to total cost. The higher is that percentage, the more leverage there is and the greater the sensitivity is. The lower the leverage is, the less sensitivity there is. There's still going to be magnified fluctuation, as you'll see, but it's greater. There are two separate types of leverage. Operating leverage, which governs the sensitivity of operating earnings to revenues, is determined by the ratio of fixed to total operating costs. Financial leverage, which governs the sensitivity of net income to operating earnings, is determined by the ratio of debt to total capitalization. More interest, more fixed cost. These are just definitions. It's not intuitively obvious to you why this is true. It's not intuitively obvious to anybody until you work through some numerical examples and see it. And that's what we're going to do in just a minute. Graphically, this is what we just went through. Operating leverage is the top half of this thing. Financial leverage is the bottom half. And the ratio of fixed costs to total costs governs this. The ratio of debt to capitalization governs this. If you have no debt, if it's all equity, there is no magnification here between operating earnings and net income because there are no fixed costs. It's only if you have debt, and of course, most asset-heavy organizations have a lot of debt. But if you have no debt, there's no magnification between operating earnings and net income. Yeah, that's another. And by the way, you want more operating leverage if your revenues are rising, don't you? Sure.
That's seasonal.
Yeah,
What
but,
is seasonal?
you know, you're talking about your strategy. Over time, if you think you can fill those towers down there, by all means, go ahead and build them, because you think you can raise your revenues, and that increase in revenues would be magnified in operating earnings if you can get the trend up. Now, that's why heavy asset investment is a risk. Of course it is. The problem is you have to make an investment decision today based upon what you think where the world is going. Because we're not there yet. There have been a lot of great strategies developed for worlds that never evolved. And so that is the angst of being being an executive leader in healthcare. Because a lot of times a strategic initiative takes a lot of capital investment. And the world that strategy would succeed in never materializes. Let me get my paper here. I mean, this is a big risk. And that's one of the things that kind of keeps healthcare executives up at night. I want to pull out a numerical example. What I want to do is illustrate this. I want to illustrate this using some numbers. You're naturally asking, why does the proportion of fixed to total cost cause this variation? Why? And why does the level of interest expense relative to, well, interest expense cause this magnified variation? Why? Well, let me just pull out some arbitrary numbers here. I'm just going to use an example. And after you've gone through it and kind of seen, oh yeah, that's why it works, then we want to talk about, well, what are the implications for you day to day for making strategic decisions? Do we want to build a big tower over here? Or do we want to invest in North County outpatient facilities? Or do I want to sell my practice to Optum? Or do we want to outsource a lot of our services, or do we want to do it with our own personnel? You'll be able to understand some of those decisions here after we get through with this. Here's an example. This is nothing more than an example. I'll tell you what. You guys need a break before we get into this thing? Okay. Let's do this. Let's take a break, come back, and I'm just going to show you a bunch of numbers here. I want you to follow these. And if you follow them, I think you'll see why operating leverage works. Okay? So let's take about a 10-minute break and then come back. We'll do it.